Obamacare, the Affordable Care Act, Shared Responsibility Payment, information designed by James Lorenzato, presented by Mark Lorenzato. This is number 8 of Series A. We have now covered who must comply to the individual mandate, what qualifies as minimum essential coverage, and what are the exemptions to the individual mandate. The final question is about tax or penalty or shared responsibility payment in IRS speak if you don't comply. The IRS imposes the penalty when you file your income tax return for the tax year, so in 2015 for 2014 if you file annually. Penalty structure. You calculate the penalty for each person monthly. To figure the penalty, you first calculate modified adjusted gross income for each dependent who files a tax return and add this up to get your household income. Then for each person you calculate two different rates, the flat rate and the excess income rate percentage for each month, and then pick the higher rate. Then you compare the higher rate to the cost to insure that person in the marketplace that month and pay whichever is lower. Next, we take this one step at a time. Step 1 is to calculate the modified adjusted gross income, or MAGI, and the MAGI of each dependent for whom you both properly actually took an income tax personal exemption deduction and who had to file an income tax return for that year. MAGI, the adjusted gross income under Tax Code Section 62 plus any foreign earned income that was excluded under Tax Code 911 plus any tax-exempt interest accrued or received, but without regard to the election of Section 1G7 to put a child's unearned income on the parent's return. Step 2 is to add up all the MAGI, and that is your household income. Next, you subtract your filing threshold under Tax Code Section 6012, and that is your excess income. The filing thresholds of all dependents who filed taxes is treated as equal to your filing threshold and not theirs, so use yours. Next, you multiply the excess income by 0.01 to get 1% of it. This is the amount you must pay per person in 2014 who don't have MEC or an exemption annually. Then you divide that by 12 and you get the amount you must pay per month. But you must pay the penalty not for each person you actually claimed as a dependent, but for each person you could have claimed whether you did so or not. Finally, you multiply the 1/12 of 1% by the number of those people, and that is your excess income rate that month. The flat rate. Once you have figured your excess income rate, you compare it to the flat dollar amount rate and take the lower rate. In 2014, the flat dollar amount per year is $95 per adult and $47.50 per child. To get this per month, you divide by 12, so it's $7.92 per adult or $3.96 per child. Then, you total up the amounts for the people who lack MEC or exemptions that month, but there's one more step. The flat dollar amount is capped at the annual amount for 3 adults, $285. So you divide this by 12 for the monthly amount of the flat rate cap, which is $23.75, the lower of your total for all your persons, or $23.75 is your monthly payment amount under the flat dollar amount. Okay. Next step is to compare your flat dollar amount per month to your excess income amount and pick the higher one. Then you compare that to 1/12 of the annual national average premium for qualified bronze level 60% health plans that cover all your dependents needing coverage offered on the marketplace for plans years beginning in that taxable year. Since your household members may change, this varies month to month. Pick whichever is lower. We don't write the stuff, we just report it. It's so simple. For each person, you could claim under Section 152 the sum of Section 62 and Section 119 plus tax-exempt interest disregards Section 1G7. If that person is required to file under Section 1, then subtract your threshold under Section 6012 times 0.01 and then divide by 12, or the flat rate of $7.92 per person and $3.96 per child if less than $23.75 per month is higher, but only if that is less than 1/12 of the annual national average premium of the lower cost bronze plan that covers all persons in your marketplace for plans years beginning that taxable year. A caveman could do it right if he knew the lowest cost national average bronze plan on the local marketplace and bronze had been discovered yet. The IRS reminds us to keep all relevant proof, and it may issue future tax guidance. How you pay. We have used the flat rate that applies to 2014. The flat rate rises to $325 per person and half that per child in 2015 and $695 in 2016 and will be indexed in later years. The excess income percentage rate rises to 2% in 2015 and 2.5% in 2016 and later years. You should include your shared responsibility payment with your income tax return in 2015 for the 2014 taxable year. If you can't pay, the IRS can't subject you to criminal prosecutions or penalty for failure to pay or levy on your property, but IRS can charge interest on the unpaid penalty and apply any overpayments you made, like your tax refund, to the penalty and bug you for it forever until the end of time and the falls of the props of heaven. Good old IRS. The IRS will be happy to help you work things out if you really can't pay on time, said the spider to the fly. Ominously, the proposed regulations appear absent on the civil penalties, late fees, etc. Now you should have a gist of how the individual mandate will operate and know answers to these questions. Who must comply with a mandate? What insurance is needed to comply? What exemptions are there? And what is the penalty? The regulations aren't final yet and some changes may occur. There will be some people and computers to help you when the exchanges open October 1st, 2013, and IRS will issue tax guidance for the 2014 tax year. But you are ready. This was an introduction to the Affordable Care Act. Health Video Services and the Video Health Guide may have other videos on Obamacare, the Affordable Care Act in the marketplace, and on helping you understand insurance policies and choosing the one that economically and practically fits best for you. I hope this helped. Thanks.